Attention all finance enthusiasts and market observers. Today, we're diving headfirst into the intriguing world of bonds, specifically focusing on the recent plunge in US Treasury yields. This is not just any minor dip in the charts, we're talking about a major plunge that has sent ripples of concern through the global financial community. Now let's break it down a bit. On an eventful Tuesday, the yield on the benchmark 10-year Treasury note took a nosedive, falling by an astounding 11 basis points to land at 2.91%. This is a low we haven't seen in nearly 2 months. It wasn't alone in its decline though. The 2-year Treasury note, which tends to be more sensitive to near-term interest rate expectations, also took a hit, dropping 10 basis points to 2.82%. These numbers are more than just figures on a financial report. They reflect a shift in investor sentiment, an increasing perception of an impending recession. This shift is driving investors towards the relative safety of longer duration bonds, like the 10-year Treasury note, causing their yields to drop. But the question remains, what's driving this shift in sentiment? Why are investors suddenly so wary? The factors are many and complex, ranging from fears of an economic slowdown and rising inflation, to geopolitical tensions and changing expectations about monetary policy. Let's not forget that these yield declines have wider implications for the broader economy. Lower Treasury yields mean lower borrowing costs for businesses and consumers, which could stimulate economic activity. At the same time, investors are reassessing their investment strategies, with potential shifts towards longer duration bonds and value stocks. It's a dynamic, ever-changing landscape, with the balance between lower borrowing costs and heightened recession fears playing a critical role in shaping future economic growth. With such a drastic drop, one must wonder, what caused this sudden change? Several factors contributed to the sharp decline in US Treasury yields. Let's take a moment to unravel these influences and better understand what's driving this downward trend. Firstly, we can't ignore the looming shadow of recession fears. As these worries intensify, investors often seek refuge in the relative safety of longer duration bonds, such as the 10-year Treasury note. This surge in demand can lead to a drop in yields, a trend we've recently witnessed. Secondly, there's an economic slowdown to consider. Data has shown weaker than expected economic performance, coupled with rising inflation, both of which have stoked the flames of recession apprehension. These signals have further driven investors towards the perceived safety of bonds, contributing to the yield decline. Next, we must consider the impact of global uncertainty. Geopolitical tensions and ongoing global instability have added to the flight to safety, exerting additional downward pressure on Treasury yields. In an uncertain world, investors often prefer the predictability of bonds, even if it means accepting lower returns. Finally, we have monetary policy expectations. The Federal Reserve sets the tone for short-term interest rates, and any indication of a slower pace of interest rate hikes can influence bond yields. Recent speculation suggests that the Federal Reserve may indeed slow down its rate increases, adding yet another layer to the yield decline narrative. Together, these factors create a complex web of influences, each contributing to the current downward trend in Treasury yields. But their impact doesn't stop at the yields. These factors have not only affected the yields but also have significant implications for the broader economy. The plunge in US Treasury yields has significant implications for the broader economy. Just like ripples spread out when a single pebble is dropped into water, the effects of this financial movement are far-reaching, influencing various aspects of the economy. Firstly, we see the impact on borrowing costs. Lower Treasury yields often translate into lower borrowing costs for businesses and consumers. This is because Treasury yields serve as a benchmark for all other interest rates. So when yields tumble, it can become cheaper for businesses to borrow for investments and for consumers to borrow for purchases such as homes and cars. This increase in borrowing can potentially stimulate economic activity, acting as a catalyst for growth. Secondly, there's a shift in investment strategies. Investors, always on the lookout for the best returns, may begin to reassess their investment strategies in light of the yield decline. They may start favoring longer duration bonds, which offer higher yields in such scenarios, and value stocks, which are shares of companies that appear to be underpriced compared to their intrinsic worth. This shift can lead to significant changes in the financial markets. Lastly, let's talk about the potential impact on economic growth. On the one hand, lower borrowing costs can stimulate spending and investment, which can boost growth. However, the yield decline is also a signal of rising recession fears. If these fears gain traction, they could lead to reduced spending and investment, which could slow down the economy. So it's a delicate balance. The overall impact on economic growth will depend on the balance between lower borrowing costs and heightened recession fears. It's like a seesaw that's constantly moving, influenced by a multitude of factors. In conclusion, the implications of the yield decline for the broader economy are profound and far-reaching. It's a testament to the interconnectedness of our economy, where a change in one area can have a domino effect on others. Understanding these dynamics is key to navigating the financial landscape and making informed decisions. The recent decline in US Treasury yields highlights the dynamic nature of financial markets and the ever-evolving economic landscape. This shift, driven by recession fears, signs of economic slowdown, global uncertainty, and changing monetary policy expectations, has led to lower borrowing costs, thereby potentially stimulating economic activity. It has also caused investors to reassess their strategies, with many now favoring longer duration bonds and value stocks. However, the overall impact on economic growth remains to be seen, as it will depend on the balance between these lower costs and the heightened recession fears. Remember, the financial world is fluid and ever-changing. As investors, it's crucial to keep a pulse on these shifts, adapt your investment strategies accordingly, and make informed decisions that align with your financial goals. Until next time, stay informed, stay engaged, and keep exploring the fascinating world of finance with us.